Okay, let's start right away. Thank you, everyone. And I see your name, Clocky, Rocky. Hey, Rocky. Lou, Pipkin, Anon Builder, Marianne, thank you everyone for joining us. Something that I always forget to mention to the guests and to everyone is that this call is being recorded, is that this has been live streamed in YouTube and Twitter. So yeah, there's more audience than we think. And we have a very special guest. We have Paul from Morpho, who is going to be joining us, and I'm going to start right away since I don't think 1 hour is going to be enough for us to discuss all the topics relevant for the scope, relevant for Maker, relevant for crypto Twitter in general, if for crypto in general. And so yes, let's start right away. Thank you for your punctuality, Paul. Thank you for accepting the invitation. So I'm going to give you a couple of minutes to introduce yourself to the people who don't know you.
Yeah, sure. Thank you very much for having me. I'm Paul. I'm co-founder and CEO of Morpho Labs, a company that was created 2.5 years ago when I was at university in Paris. I was studying like distributed systems and consensus algorithms, and got interested into DeFi and more specifically DeFi lending. And so I started looking into Aave and Compound, and very quickly realized that you had a large interest rate spread between the lending rate and the borrowing rate. And so the first protocol I built with my team was called Morpho Optimizer, and it's a matching engine built on top of Aave and Compound, and it's essentially optimizing the interest rates of Aave and Compound whilst providing the same liquidity and the same risk guarantees. And so we started with this 2.5 years ago, 2 years ago. I think we started in 2022. We grew this from zero to $2 billion. And so essentially as a product, it's like you can think of it as a lending and borrowing, exactly like Aave or exactly like Compound, but with better interest rates and same like risk parameters and same liquidity guarantees. It's a very singular different protocols. There's nothing quite like it. But very quickly, we realized that it had some limits. And the most important one being it's built on top of Aave and Compound. And we can't, grow bigger than Aave and Compound with this model. And most importantly, we have to depend on their model, which is, upgradable. So it sort of like changes sometimes, has a bunch of risk parameters. And so you have to monitor all this. So it's very hard actually to build like a large scale DeFi protocol on top of DeFi lending protocols. And so this inspired us into building something where essentially other DeFi protocols can build with confidence. And this is how we came with the idea of Morpho Blue, which I'm sure we'll have the chance to discuss. So I'll stop here for the intro. Just that we deployed this new completely independent lending and borrowing protocol 3 months ago, and it has like $1.2 billion, I think, of deposits right now.
Yeah, we're definitely gonna talk about all these hot topics. We have a lot of questions. I want to shout out to Jatmat and to Paper Imperium. We're gonna ask their questions, but please, anyone is very welcome to ask questions, inside comments on the chat. So let's start. First, I want to talk about innovation. So there are like the following points. It could be whether you're working on any of them or you have like a rough idea. So we'd love to have your point of view or insights on this. And okay, so the first one, it's like it kind of seems like it has already been resolved or at least made a lot of progress. So on the problem we saw from the beginning, it's that first it was like isolated lending versus fragmented liquidity. So Morphone is one of the main players in taking this forward. So can you tell us more about it? Like specifically, if you see innovation beyond that has been already implemented?
Yep, for sure. So I think first funny thing to say about isolated lending is that when I first saw the first mechanisms around like isolated lending, I was very bearish. I thought it was super dumb because like liquidity is so important, and if every time you have a different risk profile, you have to fragment liquidity. Then it's weird. You sort of like, complexifies the user experience a lot, and the efficiency a lot. And then I, thought about it, obviously a lot, over the last 2 years. And very quickly we realized that when designing Morpho, essentially the exercise we try to do is like, what is unnecessary and what can be rebuilt on top of Morpho. And turns out liquidity fragmentation is more of an illusion than a reality if you have sufficiently complex players. Let me explain that. On Morpho, we have isolated lending pools. So as a lender, liquidity is fragmented compared to an AVE pool. However, we have a second protocol called Metamorpho, which is, you can think of it as a vault, which has a risk manager, and that is going to allocate liquidity to relevant parties, to relevant pools. Sorry. And the interesting thing with Metamorpho is that it reaggregates liquidity for lenders. So as a lender, I have the liquidity I have available for me is equal to the sum of all the liquidity of the markets that the Metamorpho vaults are supplying into. And this way, you get the exact same liquidity as what you would get on a monolithic pool like AVE. And where it gets interesting is when you have multiple aggregators plugging into the same Morpho pools. So let me take you an example. We have the Gauntlet Vault that is depositing into USDC into the WSTEs market and to the WBTC market, right? And you have the Stakehouse Vault that is deploying in one of those two markets and into real world asset vaults. Turns out that Gauntlet and Stakehouse have different vaults with different risk, but they do share some risk. They do share some collateral in common. Well, they will share liquidity to the extent that they share risk. So it's as if Compound and AVE, they have all those different collateral assets, but they have a lot in common, right? And so it's as if they were able to share liquidity to the extent that they share risk. So that's the unique, aspect about liquidity in this isolated design plus Metamorpho vaults. First level of understanding, just to recap this, is like you have three levels of understanding of isolated liquidity. First level is, it's isolated, so it's fragmented, it's bad. Second level is, with an aggregator, you can do as well as AVE or Compound. Third level of understanding, as soon as you have multiple aggregators, like multiple vaults built on top that share some markets, well, you will share liquidity and amplify liquidity beyond what's ever possible on Compound or AVE. That's for lenders. We have the symmetric for borrowers. I can go through this as well if you want. Yeah, I know we have a lot of questions, so I hope that was clear enough, by the way. It's not the easiest topic.
Yeah, I love that you're really kind of like making really examples so we can all understand this without the necessity to become like experts or to know a lot about the topic. And you have mentioned Morpho Blue and Metamorpho. I think you explained pretty well, but like in very briefly in like simple terms, what is like the biggest difference between them?
Right. So you can think of Morpho Blue plus Metamorpho as AVE, but unbundled into two pieces. So Morpho Blue is just the core lending engine. So you can think of it as Uniswap, but for lending. So it's just one pool is one collateral asset, one loan asset, one liquidation loan to value, and one oracle. And that's immutable forever. And that's what like what Morpho Blue pool is about, essentially. And obviously, the big difference with AVE there is that as a lender on AVE, you deposit your liquidity, you don't have to think, right? They're going to manage everything for you, and they'll do the risk management, they'll upgrade the protocol, etc. On Morpho Blue, well, if you have some DAI, you want to earn some yield on it, you have to select which pool is the one that is relevant for you. So it means you have to do your own risk management, essentially. You have to decide if you want to get exposed to WBTC, to WSTEs, etc. So essentially do the same work that the risk managers of AVE are doing but as a lender. And obviously that's annoying. And so this is why we have the second protocol that is built on top of Morpho, which is called MetaMorpho, where essentially it has a risk curator where you deposit your DAI passively, like you would on Aave or Compound. And then a risk manager, say Gauntlet, for example, is able to, select which pool they're going to deposit liquidity into.
Was very well explained. Thank you so much. And I think that the next question, it's probably, it's has to be one of the first ones, since it's how did Maker end up using Morpho in the first place? Like the vaults were spun up prior to asking governance permission or approval. So who initiated this process? And what was their thinking? Morpho seemed to know about this partnership before Maker did. This is from paper.
Right. So the great thing about Morpho is that it's fully permissionless and immutable. So again, think of it as unified pools. So we don't get to be like involved in all the different processes. I saw that I think Frax deployed like similar pools as Maker or whatsoever. I did not even know they had deployed like those pools, etc. And so in the case of Maker, I don't know exactly who deployed that. So I've been chatting with like the Block Analytica team, the Spark team, and at the time, like USDE and SUSDE was like super interesting. They started like asking me questions about like Morpho, how does it work, and how it can be leveraged to essentially capture this opportunity in a way that Sparkland was not able to. And so we sort of like explained them like the different mechanisms, and then I guess they deploy. I don't know, frankly, who deployed the pool, but yeah. So that's the order of things. It actually went quite fast, to be frank. Like between the moments where, we, I guess they realized that there was an opportunity for that, and the moment it was set up. So yeah, does that answer the question? Actually, I forgot what the question was.
Yeah, my main question was who was representing that they were speaking for Maker when they first started this partnership, because the vaults were first spun up and being advertised on Twitter before Maker governance knew about it.
I'm not sure I heard correctly. So because you were like cutting off a little bit, but so you mentioned they were advertised on Twitter as Maker vaults before like the governance process. Is that correct? Right.
Yes, they were being teased on Twitter in screenshots before they were even being proposed at Maker. And so I was just curious who, since I know that there had to have been like some active partnerships, since I know Morpho put some of their own money into some of these vaults. I'm just curious who on our end was not doing the proper governance procedures, because we wake up and suddenly it's a done deal that Maker is putting money into Morpho, and governance is not really informed until after the fact.
Right. So to be completely transparent, I don't know exactly what the Maker world governance process is, but I can tell you how the events like unfolded. So essentially, like we were interacting with the Block Analytica team and the Spark team about those votes, and then I think they deployed the different markets, and then they asked about like how do we get those markets seeded, and how is the interest rate model working, and then we said, okay, we can just like deploy capital to seed it, etc. And then I think I don't know who tweeted like the screenshots first. Probably someone like from the Spark or Block Analytica team. And by the way, I'm sorry if I tweeted something that should have been approved by Maker governance beforehand. I have no like, to be frank, I have very little understanding of like what's the whole process look like. But yeah, does that answer your question? I want to make sure it answers it correctly.
Yeah, and I'm not trying to imply it was a failure on your end. It was a failure on our end. I would ask, just to close out this question, and then we can move on. Are any of those folks on your cap table? Are any of them investors in Morpho?
Oh no, like we had like 2 rounds of funding. One is was done in 2021 of $1 million. It was co-led by Nascent and Semantic. we had a bunch of angels, but I don't know. I don't think anyone was affiliated with Maker at all. And then on the second round that we did was in 2022, co-led by Anderson Horowitz and Variant. And so and at the time, to be frank, I had no no relationship at all with anyone from Maker that I know of, actually. But
thank you, everyone. And I think that that actually explains a lot. And we have a question also related to the governance process that we're going to discuss because of some ideas that Block Analytica has. It's going to come up in just a bit. But it's also good to give some context prior. Well, the following question is, what are the advantages and disadvantages that the current Morpho setup have over just using maker bolts for each of these?
right. So I think a few things. The first thing about Morpho is that you can deploy all those different pools that are like immutable with two different things. You have the first the adaptive curve interest rate model. We can talk about this as well. So the big thing about Isina SUSDE is that on a weekly basis the interest rates are changing like all the time, which like generates a lot of like operations, frankly. Like if you want to adapt your interest rates, like utilization, etc., all the time. We actually released a research paper 2 days ago on Morpho's interest rate model. And oh, can you still hear me correctly? My AirPods just died.
Yeah, we can hear you. Yeah. Oh, good.
Okay. That, you know, in order to adjust to the rates always changing on Isina without having to, you know, do like always like do some governance stuff. That's the first thing. The second thing is that you have the metamorpho abstraction, which reaggregates liquidity and makes it like super simple to supply into multiple like liquidation loan to value with one specific like DAI. What's it called again? D3M. So especially you use Maker core like to mint some DAI into a sub-DAO vault, and then the vault is able to, you know, allocate liquidity between the different, you know, risk profiles essentially. And so that's like very, very flexible. And then the last thing is about like, and I don't know how much I can share publicly about this on Morpho, but essentially I mentioned that Metamorpho was capable of aggregating liquidity for lenders. And let's just say it can do the same thing for borrowers, but it's not live yet. So what it means in practice is that if you have two markets that have, you know, different risk profiles, but you want them to share liquidity with one another, well, a borrower will be able to, you know, essentially access liquidity from all those different markets, even though they're isolated in principle. Anyway, so that like I guess it sums up like you know, most of it. Then I'd say like Morpho Blue's code is like also like extremely minimalistic. It's like 600 lines of code, and it's a singleton, right? So you can, you know, move liquidity between the different like loan to value very like easily and gas efficiently. Yeah, I know you'd love to have some alphas, but I'm sorry I can't share this one. And so like what we've seen very interestingly about like DAI loopers is that like, I mean, SUSDE loopers is that they needed to change their adapt to the rate and the risk like very frequently. And so in Morpho, they can do this like through the singleton implementation, like they can migrate their position like extremely efficiently from one pool to the other. Does that make sense?
It does. It does. I don't know if anyone, I don't know if, well, this is also a papers question, so I don't know if you would like to ask something in detail with when it comes to this answer. If not, we can continue. Okay. I'm gonna go with now then the other questions. I'm gonna go like back and forth. Okay, so we were discussing about and you explained it pretty well about what is the isolated lending and fragmenting liquidity. Oh, there's a comment here. Okay. It's not so easy to have everything. Okay, so the next topic that I would like to focus on, it's to give us like more context and to understand way better. So regarding the main aspects of the money market, we want to go through them one by one. Well, maybe not like very extensive, but what are the future, the insights that you see in the future into this? And also I would like to ask you the next topic as well, about this thing or this issue with the oracles. Some people are for, some people are against. So what is your insight on this, and if you think that it's possible to replace them based on liquidations through hoops, like in Uniswap, for example?
Right. So there's a lot in here. Maybe first about money markets. We've we've built a like $2 billion protocol on top of Aave, and this taught us a lot about what we believe should be enshrined in a money market and what should be externalized. And the approach we've taken with Morpho is we reduce it to the most simple and the purest lending engine, which is Morpho Blue, and we externalize what's unnecessary to above layers, essentially. Like you can think of it more as lending, but built in layers, right? And the interesting thing about this approach is that there is nothing that you cannot rebuild. Like all the famous, like AVC and other implementation, like you can recreate them with this base primitive, Metamorpho, and the alpha that I'm not able to share, essentially, but which is essentially, think of it as shared liquidity for borrowers. I think with this design, we're able to unlock like levels of liquidity and that are not possible like in existing like lending protocols. But most interestingly, the paradigm is very different in the sense that you can think of Aave as more of a financial product where you deposit your money and they are sort of like managing it for you. While Morpho Blue is like the unopinionated infrastructure on top of which anyone can build their own, like Aave-like pool. But what's interesting about it is they all share a common ground, which is Morpho Blue singleton. And so to the extent that all those different pools, and we have a bunch, like we have, the Spark one, but we have the Gauntlet one, we have the Gauntlet ones, they have like 5 or 6 of them, Block Analytica, B Protocol, Stakehouse Financial, RE7, etc. They all are building different, use cases. And some of them are very different. Some of them are more risky than another. But they all share this trustless and efficient common ground, which is Morpho Blue, and with which they sort of share states with one another to the extent that they share risk. And I think this, to be frank, is like I believe it's completing like 90% of what we expect from DeFi lending today. That said, and coming back to your question, like what can we do better? Oracles is obviously like a hot topic of in DeFi lending. There is like the Ajnas of the world that decided to remove oracles from their protocol, which I think is Ajna is an excellent protocol, like very, very interesting protocol, where essentially the idea and my take on oracles is that any lending and borrowing protocol needs a notion of pricing at some point to borrow, just to evaluate what's the amount of collateral that's available, but also to withdraw funds and liquidate. And in order to get a pricing, you need to get a market. And so the question is, do you internalize that market, right? Which is the approach that Ajna is doing, where they literally rebuild an entire market inside the protocol, or do you use another external market, right? Which is or an oracle, whether it's like Uniswap directly, or an aggregation of different markets through like oracles like Chronicle or Chainlink, Redstone, etc. And so there are trade-offs between the two options. That said, I have
not seen any Oracle-less approach that convinces me in terms of like security. And so what I mean by security is the level of complexity you need to get to in order to be able to have an Oracle-less system, which is enshrining an entire market in the protocol, to me is unreasonable. And we've seen it with Ajna. Again, like I have a ton of respect for what they've done, but in practice they had to redeploy their protocol because essentially they had like a vulnerability in the first version. And it wasn't, if I remember correctly, it was not a smart contract vulnerability, but an economic vulnerability where you could grief the protocol essentially. So it's very hard to build like a resilient version. And so I think, so that's on one of the downsides. The other downside is that in order to get the pricing from your own market, you need to introduce a lot of latency, auctions, which essentially are going to reduce the capital efficiency of those markets. And so to that regard, oracles are extremely powerful. So yeah, I think in the current state, and also oracles are improving. Like oracles are improving in terms of resiliency, accuracy, etc., gas efficiency for updates. And I think that's, I think we should, they always get criticized because when there are problems, it's often due to Oracle, but I'm hopeful that we can improve oracles even further. We can decentralize them even further, etc., etc. So yeah, and that's why Morpho Blue decided to be Oracle agnostic. So we don't, get to choose one Oracle or the other like Aave is doing. We just let, lenders decide which Oracle they're comfortable with and, lend to a market that is priced by this specific Oracle. Does that make sense?
So okay, it's Oracle agnostic, but it's not like you don't. It's not like you hate them. No, it's more like there are some aspects that need to be improved for you to say, okay, I like them, or I don't know, I trust them.
Yeah,
in a
like
way.
I don't think there is like one absolute like solution to the Oracle question. There are trade-offs between Oracle-less and Oracle, Oracle-based systems. I do think in the current state, Oracles provide a level of efficiency with a very reasonable like security trade-offs that makes me lean toward like having lending protocols rely on oracles being like a very reasonable assumption. However, I'm hopeful that in the long term, oracles get, either they reach a level of resiliency that is satisfying, or they get replaced by some form of oracle-less mechanism. But to be frank, I have not been convinced by any mechanism so far.
Thank you so much for your insight on this topic. We really wanted to know. Now I want to move on to more like maker related. So the next question, it's, is there a way with the existing setup to remove the need for a multi-sig control via governance facilitator?
So which control, like from Morpho, like Morpho Blue, etc., we don't control anything. Like everything is immutable. I think after building on top of an upgradable protocol, I've learned to love immutability and the guarantees it brings. But maybe you're referring to another multisig that I'm not aware of.
Yeah, on the comment. Yeah, I think that they're going to be more specific the details. I think they are talking about, yes. So it says we use a multisig to allocate the die to different molds.
We use multisig to allocate
operator.
Right. I think you only have to allocate to the die vault though, to the Spark vault, right? And then Spark reallocates liquidity within the bounds that have been set by Spark DAO.
Oh, okay. So talking about it, and please add details on the chat to the people that are asking. But there is this, I'm not so sure, and I would like to know more. So Spark, it's the one that controls the vault, but that's very general. Like that's controls, but what specific does Spark controls?
Right. So just first disclaimer, like we have like 20 different vaults on Morpho, so I'm not aware of the configuration specifically of all of them. But essentially, my understanding is that they have Spark Vault, where DAI gets deposited into. And so the admin rights that you have as a vault is the following. Under a time lock, you can add a new Morpho Blue market to which DAI can be allocated. So essentially, Metamorpho Vault has a whitelist of all the different markets that they are able to provide funds to. In that case, that would be DAI. And they're able to add new markets to the whitelist. And if they do, propose a new market, then there is a time lock. And then, but I don't know who in practice is the owner of that vault. Like my understanding of the core plus sub-DAO structure, and again, I'm not super familiar with the exact implementation here, is that Maker would mint DAI into a Spark control vault, but I'm to be completely frank, I don't know the exact implementation of that.
By the way, Paper, you can have the mic, no problem. It's commenting on chat. Spark doesn't really have anything to do with, as far as I know, but it sounds like it's worth moving. Well, on this space, a very recent one, that's the one that was a few weeks ago, and I asked this because that's what I heard on this space. So Rune mentioned that the vaults were controlled by Spark. It just like that, and it didn't specify which vaults and which in particular were controlling. So that's why that was my question. But I think we're talking about
just maybe to make sure we're on the same page on the vocabulary. So we have two abstractions. We have vaults and we have markets. Vaults are the aggregators, which can be owned and managed, and the markets are immutable and cannot be managed. And so my understanding, and this is what we put in the Morpho's front end, is that Spark DAO is owning the vault.
Yeah, I think it's an issue on our end again. So I think if I have your terminology correct, there's 8 markets or whatever, 10 markets. And there's one vault. The vault is on our end controlled by a multi-sig that's just one of the governance facilitators. It really doesn't have anything to do with Spark. And so my question was if there was a way to automate that so we don't have to have just a guy in charge of that.
Oh yeah. It's fully configurable. You can, change the owner. You can put a bot instead of, we have different roles in the vault. You have the owner, you have the risk manager, and you have the allocator. So owner is the super admin. Risk manager is deciding which market can be added. And then the allocator has the power to move liquidity between those different markets. And each of those are configurable, and you can change the roles of each and automate it in the way you like.
Oh, thank you. And also I see that there are comments on the chat. Thank you both Wizard for being here. And yeah, they can give a little bit more clarity, but then again, yeah, we do need more I don't know, details. But it's fine that you could give us some light into these topics. There was a topic that I was not exactly as we're talking about right now, but still it was seriously just give me the rest. Okay, I'm gonna go with the next question. So it says Maker stands out as not getting any more for rewards. How can Maker become eligible for these? And even if Maker continues to be excluded, how can other vaults that utilize DAI become eligible?
Right. So I guess the way we think about rewards in general is that they're an excellent tool to bootstrap markets. So when you create a new market, you need lenders to get borrowers, you need borrowers to get lenders. And it's a chicken and egg problem. And you need some Morpho, you need some kind of initial incentive to bootstrap and get the market going, right? And to bring together lenders and borrowers. And so tokens are such a great way to, do this job And so this is what we've been doing with Morpho incentives on some other markets, not all, but where there is no way to bootstrap the markets in an efficient way. In the case of Maker's D3M, well, there is no such need because the D3M is able to automatically allocate a lot of DAI into the different markets. And so I think that was the initial rationale. And also, to be clear, we have no financial interest in this. We're not earning any fees in this. So I think the trade-off also can be that Maker is able to use all this immutable infrastructure for free. And so yeah, I'd say that's what we would give, quote unquote, to the Maker community. So yeah, and so on the other markets question, I think in order to be eligible for Morpho Reward, so you can go through a full governance process and just propose it in the Morpho forum, and then have the Morpho token holders vote for this. I'd say the main arguments that we can see is bootstrapping, as I mentioned, and then if there is a rationale behind I don't know, co-incentivization or one specific behavior that is great for the network that would be worth incentivizing, then I'm sure we can look into it and vote for it. And yeah, and by the way, I think Gauntlet has a DAI vault, and Gauntlet is I don't know if there are incentives distributed on this one. I have no idea, but maybe there is. But they could completely be eligible.
Well, thank you. And okay, I found the one question that was kind of related to what we were discussing, but this is more into the risk parameters. So there is a key issue, and this is from different posts from VA Labs, that they mentioned they want to reduce the intervention of risk managers from or governance. So they want to make them automatically regulated, for example, Ashna with its innovative mechanism. So what is your insight in this? Do you think that this is possible and viable, and this would improve the way it is now if it's automated?
So I'm not sure I fully get the question. But is the question that risk management of the Metamorpho vault owned by Spark that will eventually be automated? Is that the correct way to?
Yeah, it's like similar to Ashna, right? So it's not that way. It's a whole process. You have to submit a proposal, and then it has to go to executive voting, and then it has more time. Of course, this will be different if it will be automatically regulated.
Right. So and I think you could already have this in Morpho without touching anything. So one thing that I think BA Labs has been doing that I think is super interesting is just deploying 4 different loan to value ratios markets, and the bars are pricing differently the different markets according to the leverage they're able to get there, and there is a cap for each of them, and sort of the markets is pricing the risk of each of those markets. That said, you have caps that maybe this is where you have room for automation, and essentially regulate those caps a bit more smartly, I would say, to limit governance intervention. And so I don't know exactly, it's probably the plan on their end. I don't know exactly what's what they're going to do with this, but in general, we're big fans about automating, and making immutable what can be, and removing governance from all the complex risk decisions is always a good thing, in my opinion. So yeah, but I don't have specific insights on BA, plans or anything.
Oh, okay, it's good to know. Just to put it clear, it's 2 different things. For example, On the one hand, they have mentioned that they want to reduce this intervention from governance, from risk managers. But on the other hand, Maker wants to hire more risk parameters. And it's because, if I'm not mistaken, this has nothing to do one with the other, right? Because risk is just so complex and in general, and it has a lot of fields. So even if it's like automated, and I want to have this clear, if it's automated, like you would still need like people, right? Risk parameter, like not just
Right. So
everything with algorithms.
I think that's a very fundamental thing about risk management in general, is that risk management is somewhat about predicting what's going to happen in the future, and there is no such thing as an algorithm that is able to predict the future, at least today. And so it inherently requires some kind of like manual intervention, because you have to adjust and react to a system, well, essentially to the world, which has like infinite number of parameters. And so to that regard, I think there's inherently things that you can't automate. However, the way Morpho is structured is that risk gets priced at those different markets. So the each market has a risk that is set in stone, and then the lender, so in that case Spark, has to be active and thoughtful about allocating liquidity in one market or the other, etc., etc.
Yeah, that's good to have it like more clear. Now you mentioned about you don't know much about what VA Labs. There is one. I don't know if you have anything to say about the following. VA Labs has intimated that 27% return is needed to justify the risk of lending versus the FINA assets. This is currently beyond the kink in the utilization curves for all but 2 volts. This means Maker has to target a return that it's in the highly volatile, uh, more than 90% utilization portion of the curve. Is there a way, directly or via workaround, to change the interest rate curves of the existing Maker Morpho vaults? Would you like to
Right.
have anything to say?
So a few things about this. So the interest rate market of Morpho Blue is ungoverned and general and fully automated. So it reacts to the market forces entirely. And so there is no such thing as like an update function that you can change the rate and in 1 second, etc. All the rules are programmatic, and you can anticipate what they're going to be, etc., etc. What Maker can do, however, is just simply, so in order to move the rate that you target, so the kink that you're referring to, what Maker can simply do is like withdraw funds in order to get the rate up. And if the rate is up and above utilization targets, then the kink will start to grow. So that's like one thing that you can do to get the rate up, etc. And so that's like essentially the interest rate model in itself isn't governed, but reacts to market forces. Market forces are driven by borrowers and lenders. Maker is a lender, so by withdrawing funds, you can play with this essentially. That said, so I don't know that 21%, is it for all LLTVs? I think naturally it should be different for each LLTV, because it's different risk premiums, so it should be different rates. Like lending against SUSDE at 95% is not the same. Weighted average. Okay, interesting. So it's not the same. It should theoretically not be the same rate. And so if for some pools that are the more risky, it's above, and for some pools that are the less risky, it's below, then it should probably look fine. And then if there is some adjustment to be made, then fund has to be withdrawn. And by the way, like the vault can simply put it in an idle market, so like just put the DAI idle without having to recall the funds with like the whole Maker process. Like the vault itself is able to reallocate liquidity to play with the rate essentially. And so short answer is yes, you can move the kink, but not by modifying the code, just by withdrawing liquidity or supplying more liquidity, depending on what you want to do. And then it will self-adjust.
Now we're gonna get into a little bit more technical, but again, I think that right now you are explaining it pretty well, so I don't think there's gonna be like an issue. So when we talk about liquidations, there seems to be a ton of innovation in mechanisms like Llama or UAV4. Even like hooks, like Fluid, like Instadap. Um, do you have anything to say or insights into all this?
Yes. So I do. We've been thinking a lot about liquidations in general. And so you have the liquidation design space is huge. You have all sorts of auctions, Dutch auctions based on health factor, based on time, English auctions. You can have like close factors, like what Aave is doing. You have a bunch of different designs. What is one thing is true about all those designs is that there is only one that is the fastest, which is the fixed liquidation incentive mechanism. And that's, any other auction, it's an auction, so it takes time to happen. So because it takes time, price can move, right, during this time. And so, potentially this is exactly, you want liquidation to happen fast in order to limit bad debt. And so, that's, and also to maximize like capital efficiency and the leverage you're able to take. And so that's one thing. And so, but fixed liquidation, is annoying because when you get liquidated, well, you lose a bit of money, right? And so the interesting thing is that you can rebuild all those different auction models, like that I was mentioning, on top of the Morpho Blue protocol. And so and I think Summer Finance and DeFi Saver have sort of built some things like this on Morpho Blue, where essentially the idea is the following: if your liquidation loan to value is like 80%, and at 80% there is I don't know, I'm giving random figures, like 5% liquidation incentives. Well, what you can say is at 79%, I'm happy to be liquidated at half of this, right? At like only 1%. And so you cannot have those auto liquidation. You could put a Dutch auction in place. Like you could say between 78% and 80%, I'm going to progressively be liquidated. And the more I lean toward 80%, well, the bigger the liquidation incentive is going to be for the borrower. So that's like I would say like how we're thinking about it. The fastest and the most primitive is enshrined in the core protocol, and then all other auction mechanisms are very opinionated, and so it's for borrowers to decide which one they're going to elect and which one they're going to essentially borrow use to be liquidated. And you could also simply just protect yourself from liquidation, which is another option. Does that make sense?
It does. It does. So, but I think for the next one, I am going to copy the question. I think it's gonna be more clear. Since it's a very specific question, shout out to Jatmant. And okay, I put it on the chat.
Right. So on the Easy East events, so I think the way people should think about Morpho is like Uniswap. In the first hour we deployed Morpho Blue, we had the first scam markets where if you deployed some liquidity into it, you get rugged, essentially. Right. And it's the same thing with Uniswap. You have a bunch of scam tokens. I mean, front ends do a better job, like in Uniswap, at creating which token is a scam, which token is charging you extra money at every swap, or those kind of things. And I think it's very important to understand that Morpho is very unopinionated about what happens. Like if some market gets rugged, does not impact any of the other markets. If there is like a huge bad debt that gets accrued to lenders, does not impact any of the other markets. So it's like each market in Morpho Blue is behaving independently from one another. Then again, get reaggregated with Metamorpho, but that's another story. And so in the case of Easy ETH, what we had was like Gauntlet and RE7, both of them had a lot of ETH deposited in some. So they had 2 vaults depositing into one market, into multiple markets, but they were sharing liquidity in one market, which was easy ETH to borrow ETH at, can't remember the liquidation loan to value. And turns out, it was priced by a Redstone Oracle, and turns out the easy ETH, depegged. And so borrowers that were borrowing from that market, well, they got liquidated, which is like the expected behavior, especially given that easy ETH, is like significantly more risky and than assets like WBTC, for example. And so I think the Gauntlet Vault realized a loss of 0.07% of their vault, which accounts for like a day of interest or something. So it's like has been widely overstated on Twitter, I think, on my opinion, saying that Gauntlet has done a bad risk management, etc., which I think is personally, I think is unfair, because the vault is yielding like 30%. So of course it does not have the same risk profile as an AAV that is yielding 2%. And of course, some losses can be taken. Any product that's described as risk-free really isn't, like that's not really possible. And I think the loss that they took is pretty minimal. Regarding what can be improved on Morpho, I think 2 things. I think we should do a better job at explaining that Morpho is not like Aave. Like Morpho is a base infra on top of which anyone can, do what they want. But of course, you can do very risky things on Morpho, and you can get burned. And I wish we did a better job at explaining this, and we will continue to improve this, whether it's like through the way we communicate with people, but also in the front ends, explaining what's the deal with all those different markets, etc. So that's the first thing. Second thing is that we wish we had those Dutch auction, like opt-in Dutch auction or English auction, etc., like mechanism in place at the time for the liquidators. At least like an open tooling that they can use if they wanted to, because I know some liquidation were quite harsh. But all of this is like very solvable, and I think the overall impact, like for the Gauntlet Vault, that was that was the main thing that was on Twitter yesterday, is that Gauntlet had done a bad job at risk managing. I encourage you to look at their report. It's very complete, very well written, and it explains essentially that there's nothing wrong about it. It's just everything's behaving as expected. Feel free to let me know if you have any other question on this topic.
I think that is about like a risk decisions. Once is your decision as user. Okay, of course, if I have high yield, gonna be high, the risk gonna be higher. But sometimes we tend to forget. It's like, oh wow, I'm gonna receive more rewards or more yield, and it's kind of like an issue that everyone has gone through, I think. And also, I was just thinking about this the other day, like when we get into crypto and we were start, like I don't know, investing in crypto, right, and having tokens, there's not like a right path, and it's not like, okay, what you should do or you shouldn't do. It's more like you don't even think about your risk profile, and it sometimes it just, of course, depends on your own. It's like you have to do your own research, and you have to listen to the right people. But I think there we need more of this, like, I don't know if call it like
Right. And I think
financial
like
education, because that sounds
it's mostly because like people are used to Aave, which promises risk. Like, I mean, they're not promising risk-free, specifically, but essentially they're saying they do whatever they can in order to prevent user losses, which is a very different paradigm than a completely permissionless infrastructure on top of which anyone can build the risk they want, right? So yeah, I guess that's the main thing that people need to get used to. Risk-free does not really exist, and if we want DeFi to scale, we want to be able to offer different risk and compliance profile to people, and users will need to have the choice to decide what they want, what risk they want, and if they're not able to make this choice on their own, then there should be abstraction layers like Metamorpho in order to bring intelligence and activity where passive users are not able to be active and sophisticated, essentially.
You mentioned just now that everything has gone like as you predicted. So that means that everything's going is going well. You would call this a success. And although it can be said that there are only link I mean Maker and Spark specifically, they can be linked by one asset that is USDE and its variant that is SUEDE. But do you find like new alternatives or possibilities for the future to work with Maker?
Right. So, as I said, Morpho Blue plus Metamorpho plus Alpha is able to, essentially provide, like I don't want to say the same thing because it's like not the same code and everything, but very, very similar thing as AVC or Sparkland, but with a lot of like additional like advantages. First, like the like it's stupid, but just the number of lines of code is much smaller and everything is immutable. And when you just look at the number of incidents that happened on like monolithic lending pools over the last 2 years, and frankly, I've been building on top of them, it's just like a nightmare, right? Like, so I think this in itself is like a huge value proposition. And then you have a bunch of like very interesting features that you don't have in all those existing lending and borrowing platforms, which are per collateral risk, for example. Like each collateral and like each oracle has its own rate. And usually this comes with fragmented liquidity because it's isolated design, but here the good thing is that liquidity gets reaggregated. So it's like as if you were adding a new dimension, which is how much liquidity can be shared between markets and how much you want risk to how much you want risk to be fungible between different markets, essentially, if that makes sense. So yeah, so we're starting with SUSDE and USDE, and Maker is allocating DAI into this. I think there's potentially a path where you could do more than as a Maker community, you could do more than just those two assets. For example, WSTs and WBTC on Sparkland have like some leverage caps. If you have a similar strategy of what BA Labs has proposed with SUSDE, you could have WBTC with much higher leverage than what is able on Sparkland, but with a limited cap, right? For example, same thing for any other assets, and then each collateral has its own rate, which enables you to access markets like LRTs or real world assets and different compliance profile, different risk profile. So it's overall much more flexible. But then I'm not the one deciding here, and I'm very happy to give like as much detail and as much like as part of due diligence, do whatever we can to help you through this. But I'm confident that Maker community can transition more and more assets and capture more and more opportunities on Morpho.
We're about to end, but I don't want to miss the chance because you have mentioned about all the risk managers. You mentioned the best risk managers in the space building on top of Morpho. So you have like Gauntlet, Block Analytica, you have RE7, you have more. So we're very interested to know how is the process, like how do you select, or is it like
it's fully permissioned. Like, we don't get to decide anything. That's the cool thing about Morpho. Like all of this is like completely immutable and permissionless. Like those are two very important keywords in my opinion in DeFi. And anyone is free to deploy the markets they want. Anyone is free to deploy the vaults they want and offer like their risk management to anyone. So yeah, and one thing I didn't mention about Morpho is for like the advantages is, I mean, I sort of mentioned it, but it's definitely like the shared state between all those markets. Like for example, Gauntlet has a DAI vault, and maybe some of the markets they have will be in common with the Spark Vault, and so the Spark Vault will have increased liquidity that is coming, from Gauntlet, and then did not even ask for it, but they get additional liquidity, additional efficiency, etc., etc. So just the idea of having everything aggregating at one single smart contract, which is Morpho Blue, offers this additional flexibility. Anyway, it was not the question. Answer to your question was it's permissionless.
Yes, and the last one, I think that this is the one that most people want to know. It's what is the token release?
Oh, for Morpho? So the token is already generated and live, and so you have a non-transferable token that gets distributed. So it's like points, but with more predictability, because you know what share of ownership you'll get when you perform specific actions on the protocol, and so the token is not transferable right now, but can become transferable at some point, and it's a function that's DAO gated, and so it has to be voted by governance. And frankly, I really want this to be a genuinely decentralized process, in the sense that we've been distributing ownership to users for a year and a half, though, for now. So it's been I think users have significant ownership now. And we have performed rounds of funding, so we have investors, and we have also contributors that have tokens. And I think finding the right balance between those three different pillars and engaging into open conversation is something that's needed. There is also a legal component to it, as you probably know, there's a lot of regulations around and points of attentions to have when launching a token. And then finally, there is timing. So decentralized legal and timing. And I think the timing for it is when Morpho enters a growth stage, which it looks like it's entering right now. So the market conditions are favorable. Morpho is growing rapidly, and there's a lot of things going on. So yeah, I guess it's just a matter of getting the DAO to decide on all this and getting the right legal approval, so that we can launch the token. So I don't have any specific timeline in mind, frankly, but at least those are the conditions that I consider necessary in order for the token to be transferable.
Oh, that actually helps a lot. The information that will give us more detail into this. We finished with this comment from Anon Builder, and it says, "I don't know if it's very controversial, and I don't understand the subject either. So I don't know if the question is valid, but I remember there was some post about Maker not receiving part of Athena's airdrop for having the funds in Coinbase, and that they asked Athena if this could be fixed since Maker got screwed." Do you want to comment on this? Do you have any comments, insights?
So I have no idea what this is about. I know there is some shards distribution. I'm sorry, sometimes I don't have
rewards. Yeah, some kind of rewards that
no, but I'm sure. Yeah, I would be surprised if something was explicitly distributed and then not operationally distributed later on. But yeah, I don't know, to be frank. Okay, I'm sorry, I have to jump. So
that's. Thank you so much. You say 45 minutes, and we have done more than that. So thank you, everyone, for your participation. Thank you, Paul, and see you next week. Bye-bye, everyone.
Thank you. Bye.